Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Tom Anderson. Tom is the president of the Retirement Income Trust Association, and he's also a director, founder, and past president and CEO of Pensco Trust, which is an IRS-approved non-bank custodian for self-directed retirement accounts. Tom grew up in New York and in 1969 started working at Hartford National Bank, where he became the head of systems development and strategic planning. In 1981, he came to Bank of America in California, where he became head of trust system development and trust and stock transfer data processing. In 1989, he co-founded Pensco Trust. Tom has testified to the Department of Labor and the Internal Revenue Service about IRAs, instigating changes to the IRS regulations governing IRAs, specifically relating to the capital requirements for any company offering IRA services. He was invited to Washington, D.C. in March 2009 to participate in an elite group called the Future Finance Initiative to make recommendations about the future of banking in the United States. Today, Tom and I are going to be talking about investing in real estate using your IRA or Roth account. Now, as we get started, I want to caution our viewers, we're discussing issues in a very complex area. This is just a starting point for a bigger discussion with your other advisors. Get qualified legal and tax advice. Tom, welcome to the show.
Well, thank you, Michael. I just want to add that the RITA designation is actually Retirement Industry Trust Association.
Oh, industry, I'm sorry. Okay.
We don't want to confuse the people with the other association, which is the Income Association.
Okay, so the Retirement Industry Trade Association.
Basically, it's a trade association of all self-directed IRA custodians.
Okay. All right, Tom, why don't you let us know a little bit about why did you get into the area of offering independent trust services for IRAs or individual retirement accounts?
Well, basically, after I left Bank of America, I was doing some consulting. I formed a consulting company to banks and trust companies around the country. And I got an assignment to basically straighten out one of the trust companies that was offering a self-directed IRA service. And I realized during that consulting assignment that the skills I had learned over the years in my on-the-job activities, specifically writing and developing and advising people on trust systems, were suitable and very appropriate for handling self-directed IRAs. Mm-hmm. So I started investigating the business and the industry and the market and decided it was something I wanted to go for, and then 2 years later I formed Pensco.
Okay, great. Now, your career has taken a little different direction. You were president for many years of Pensco, and now you've helped to found this new Retirement Industry Trust Association. Maybe you'd like to tell us a little bit about it.
Sure. Actually, I didn't found this organization. It was founded actually before Pensco, in '87. But okay. I was elected president for 2 terms now. Okay. And basically, I wanted to retire from day-to-day full-time business, getting on a little bit. And I left Pensco voluntarily initially to retire, and then I started getting involved with the association, and it's become more than a part-time activity. But I enjoy it, keeps my head in the game, and gives me the ability to interact with the government officials associated with retirement issues.
Okay, great. Why would someone consider the alternative of a self-directed IRA with an independent trustee?
Well, there are self-directed IRAs that are available through the traditional broker-dealers, whether it be Schwab or Ameritrade or E-Trade. They typically don't give advice. They allow people to make their selections of mutual funds, stocks, and bonds. But a self-directed independent firm basically is not in the business of selling securities or any other investment for that matter, nor in giving advice. It's strictly up to the investor to make the decision. As a result of that, they don't limit you to a narrow array of investment opportunities like stocks and mutual funds. You can go beyond that, anything that's permitted under law, under the IRS regulations.
Mm-hmm. Okay. So how is this service, again, different from self-directed plans at a bank or a brokerage company?
Well, as I say, there are only three things that you can't invest in with an IRA. One is the stock of a subchapter S company. Another is anything that would be deemed to be a collectible, like artwork, numismatic coins or collector coins, liquor like wine collections or whatever. And the third is life insurance. And beyond that, you can invest in anything. And over the years, wherever I speak, I always tell some of the interesting stories, which I think we'll get to later, about things people have done with their IRA that people would never otherwise, realize they could do. Because the majority of IRAs are still invested in stocks, bonds, and mutual funds because of the self-directed IRAs are relatively new, and also the marketing muscle of the self-directed industry doesn't compare to what the securities firms can muster.
Yeah, it's hard to go against Merrill Lynch or whatever.
Well, not Merrill Lynch so much anymore, but some of the Fidelities nowadays, and some of the Schwabs and those kind of firms. Yeah.
Right, those are big players.
Right.
Okay, so what are the different types of retirement plans that are handled by Pensco?
Well, like most of the firms in the RITA Association, we handle all the IRAs, Roth IRAs, traditional IRAs, educational IRA, SEP IRA, and we also handle solo 401ks. We also will handle custody accounts for people who just want us to hold traditional assets, alternative assets, whether they be real estate or gold bullion or whatever. We work with in the case of metals, we work with a depository trust company out of Delaware that's associated with the Commodities Exchange and regulated by them.
And I guess one other account that you didn't mention, but it's sort of a variety of the others, and that's the Roth account. So
sure, Roth IRAs, any type of IRA, because there are others that are in the works, like an automatic IRA and things like that. We would be associated with any of those IRA products.
Okay, good. So now let's get into this area of real estate. Why would someone want to invest in real estate using an IRA or a Roth account?
Well, real estate is a whole different asset class that generally is not correlated to the stock market. So if you think that you want to diversify and add a little bit of a buffer into your portfolio, whether it be your IRA as part of your overall wealth spectrum, or just using private funds into real estate, if you decide that you do want to have some real estate, putting it in an IRA has some real advantages. Number one, you can use leverage inside of an IRA, which many people are not aware of, and you get the same kinds of tax deductions that you would get if you were investing with taxable funds. However, the net income will then go into the IRA and grow tax deferred or tax free if you're using a Roth. Secondly, I mentioned the diversification factor. Instead of having all stock related investments, which most people do in their IRAs, that are then subject to the whims of the stock market, because generally when the market is down, all the assets within the market go down with it. You can buffer that by putting in other non-correlated or less correlated asset types, including even variants of the real estate quadrant, because you can buy, for example, rental property on the shore of the Mediterranean if you want, and lease that out. So you can get into foreign real estate. So it's really breaking up that single-mindedness or single approach to the portfolio of having all one related asset class in stocks and bonds.
Okay, so maybe we'll talk a little bit about terminology for just a moment. So some folks may not be so familiar, but Tom mentioned correlated. So when we're talking about correlated, we mean that the price movement, whether it's similar to, in other words, if a lot of stocks, the prices will tend to go up at the same time, especially if they're like all tech stocks, pretty much will go up at the same time and go down at the same time. So we say that their prices are correlated. And in modern portfolio theory, which is an investment theory, basically to diversify, the idea is that we're trying to find opposite price movements to try to stabilize the portfolio to some degree.
Sure.
Yeah.
And real estate being a real property has its intrinsic value, and it generally doesn't. you know, 2 acres in Idaho don't necessarily even correlate to 2 acres in San Francisco. It's
Right.
specific to that demographic area, the demand in that demographic area, and in most cases, very little in the short term to do with the stock market. So if there was something going on in the Middle East that was considered negative for the U.S. economy, that might affect the stock market tomorrow, but your 2 acres in Idaho probably wouldn't change in value. So it adds that buffer, if you will.
Yeah. Also, I mean, there are things that can be done to help to enhance the performance of real estate. Has to do, you know, with management and things like that, where your control over what's going on inside of this company that
Absolutely.
you've invested a stock.
Yeah, self-directed IRAs in general are, for the most part, require more involvement by the investor, because first of all, they have to pick out the investment. They're not going to be told, or they're not going to have that handled by, let's say, a securities advisor or investment advisor. With all the self-directed custodians, you can take that responsibility on, and have to, unless you also decide otherwise to have an advisor. But that advisor will not be provided as it might be by a Merrill Lynch or Fidelity when they get you involved in securities. They will have their advisors. The custodians that are in our industry don't have those advisors. Mm-hmm. So it is incumbent for the self-directed investor to understand and pay more attention to their investment properties. And typically, let's say somebody buys a rental property with their IRA, whether it's leveraged or not, and you know, they may then participate by selecting the tenant and doing the administrative work, as long as they don't do active management in the sense of, you know, repairs themselves on the property. They have to farm that out to legitimate professionals, but they will be paying more attention to that kind of an asset. Mm-hmm. And you know, it may be helpful for them if they buy something in their local community. They can actually drive by and check on their IRA-owned property.
Right, right. Who's responsible for preparing income tax returns for these IRAs if they have something we will talk about in a few minutes, this unrelated business taxable income?
Well, if they don't use leverage, then that's all taken care of by the custodian. There are no income tax because all the income is deferred or tax-free. But if they do use leverage, then the portion of the income or capital gains that are derived from the use of leverage, let's say it's a 50% down situation, then 50%, which is the leverage portion, that wasn't funded by the funds out of the IRA, was borrowed from either the seller as a carryback or borrowed from a traditional bank. Any income associated with that 50% or any capital gains at the time of sale would be subject to unrelated business income tax, and also would have the deductions of the normal deductions of the, let's say, mortgage interest, repairs, and things like that. And then you have a $1,000 waiver. The first $1,000 of net income after those deductions is waived by the IRS. Mm-hmm. But the preparation of the form, which is called 990T, would be done either by the individual in the simplistic case, let's say it's just a single rental property, or by their CPA.
Mm-hmm. In other words, this is not a service that's done by Pensco or the service provider. This is something that the customer, the IRA owner, is responsible for taking care of that tax reporting.
Well, and I can speak for all of the industry as the president of the association. None of the custodians will prepare 990Ts. That's just the way the industry works. Yeah. And that's why professionals like you are out there to help the client.
Right. Now, isn't there a trader business? Well, we talked a little bit about that. I guess I'll just mention there can be other situations with real estate where you can have a trader business, and that's for some people, they're more actively involved in buying and selling properties. So in other words, the quick turn or the quick flip type of activity, when you're trading a lot of properties in a year, that actually can be considered to be a business and also subject to this unrelated business tax.
You know, there are some considerations there, and again, a CPA like yourself can guide people through that. But if you don't make a habit of it, and there's some gaps in how often you do it, and you also maybe have a full-time job, and therefore it can't be proven that you're spending all your time doing that. There are ways to sort of defeat that, if you will, legitimate ways to defeat that argument by the IRS. On the other hand, if all you're doing is buying and flipping, or buying, developing, and selling, then you've got a real estate operating company, and you're basically competing with other development companies, and therefore, like any company, you're going to have this tax. And it just so happens they call it unrelated business income tax for nonprofits and tax exempt IRAs.
Yeah. So I think we'll just leave it at that, but people need to be aware that it can be an issue. Like I said, we can't and don't want to cover all contingencies, but you need to talk about this with your tax advisor.
Sure.
Okay. So as a real estate investor, what things can you do and what things can't you do when real estate is held in an IRA or Roth account?
Well, just like when you manage your own personal Schwab IRA account, when you're making the decision to buy and sell or whatever, you can make those intellectual decisions, including selecting a tenant, sort of ministerial kinds of activities. But once again, you can't go over there and mow the lawn every 2 weeks personally. You can't go over there and fix the toilets, and you can't go over there and paint the rooms or fix the roof if you happen to be a developer or things like that, nor can anybody that's directly related to you, either as an ascendant or descendant. So you can't hire your son, who might be a developer, to go put a new roof on the IRA-owned property. The IRS looks at that as an illegal contribution to the IRA, and that would be subject to penalties. So there are all the websites of all the providers in the industry, including Pensco, have sort of guidelines on those kinds of things that you can and cannot do without getting into trouble. But essentially, the laws are set up where they don't want individuals to touch the assets in their IRA while they're pre-retirement. They're designed to be saved for retirement, and there are certain restrictions over what you can and cannot do. But ministerial things, decision making, picking a CPA, picking a property manager, all that's perfectly okay.
Right. But no, there is an issue. So let's talk a bit about this prohibited transaction, particularly related to who you rent to.
Sure.
So there are certain people that you can't let use this property, isn't that right?
Oh, absolutely. And one of the problems with any industry is that there are always some mavericks out there that make, for marketing reasons, make some pretty outrageous claims of what you can and cannot do. And when you drill down, you find out they're really twisting the realities and the facts. But the fact is, you cannot buy an IRA, with an IRA, a piece of real estate or a property on a piece of real estate and occupy that personally in any way while it's inside the IRA. Nor can you, buy or give your son the down payment through a loan to them for their first house, or rent your rental property that's owned by your IRA to your son or your daughter.
Mm-hmm. So there are certain relatives that are disqualified.
Right.
And as I recall, it's pretty much your lineal descendants, and then it's your ancestors. So you can't rent to your parents
and your
or to your kids
and your son-in-law or daughter-in-law.
Right, because they're married to your child.
And ironically, excuse me one second. Ironically, you can actually rent it to your sister or your brother.
Yeah.
However, when you do so, you need to be careful that you're doing it on market-related terms, because if you give them an extra benefit, you're depriving your IRA, which has to follow the exclusive benefit rule. That is, the transaction that your IRA engages in, regardless of what it is, including renting to your brother, has to be done to benefit the IRA predominantly. You can't help your brother out and give him a break on a lower than market rate. So you've got to be careful that you make it a legitimate investment.
So you want to document what the fair market value rent is in the community.
Sure. Get somebody like an independent broker to give you an estimate of what the rent should be for that property, and just put it in your file in just in case you ever approached by the IRS.
So are there any other disadvantages about investing in real estate in an IRA or Roth account that you you want to point out?
Well, like any asset inside of an IRA, you really can't take full advantage of it until you reach 59.5 to avoid a 10% withdrawal penalty. So if your plan is at 25 to buy this rental property and move into it at 55, that's not going to work. You could move into it at 59, but you're going to pay tax at its fair market value at that time, which is okay, but it's probably going to be appreciated over those years. Or if you purchase it in a Roth IRA, you can occupy it at 59.5 without any tax impact. So depending on which way you do it, there are some holding rules so that you can't really touch your property or your assets in your IRA until at least 59.5. At 70.5, you have to take them out of a regular IRA, but not necessarily a Roth IRA. Right. So it's basically the best strategy for buying real estate is for the purpose of making a good investment. Mm-hmm. Either an investment that's going to have capital gains or an investment that's going to produce income. So right now, the market is good for buying property at a reduced value, and because of the low mortgage rates that are available today and the reduced market value and the higher rents that are now being garnished, you can get a much better deal on a cash flow basis. And so you can start generating net cash flow in addition to growing equity over a period of time. So it's an excellent time to buy income-producing property. It could be a commercial building, it could be a strip mall or part of a strip mall, and you lease that out to businesses. So it doesn't have to be, a residential property.
Right. So I think that the thing to recognize, like any other investment, so first of all, at least right now, we have lower capital gains rates outside of the IRA. When income is distributed from an IRA, a regular IRA, that's going to be ordinary income. But the idea is most of us, where we have our funds to work with is in our retirement accounts.
Well, sure. And that's true. Particularly for the boomers who've retired or retiring at the rate of $10,000 a day, they've accumulated a lot of funds in their 401ks over the years, and they immediately get pushed into IRAs, and many of those are going to be self-directed IRAs. And at that point, they've got a bundle of cash they have to allocate. And right. The worst thing they could do is put all the chips down on black, like they would at in Vegas, because you have a 100% or 50% chance of losing everything. So spread the money around the table, or spread your investments around to various asset classes, as we talked about earlier.
Okay. So we're going to be talking some more about alternative investments in another interview. So folks, keep an eye open for that. There is a thing too about the IRA. You just have to recognize, in a sense, this is almost viewed as a separate taxpayer. It is and isn't. But in other words, though, it's a separate fund that's more or less locked up.
Absolutely. In fact, you as an individual and owner of your IRA are called under the law, which is interpreted within IRC 4975, as a disqualified person in terms of that IRA having a transaction with you personally. So you can't, for example, we had people recently ask us, can I use my IRA funds to mortgage my own house because I'm paying too much and I can't get it refied by the bank, but I could pay it off with my IRA funds and then charge myself 2% or whatever. And the answer is no, because that's a transaction between yourself and your IRA, and you're a disqualified person in terms of that transaction, as is your spouse. So you can't do things like that. And of course, I didn't make the rules up. I happen to be pretty much of an expert in this area, but there are a number of prohibited transaction issues that you have to be aware of, and your custodian, like Pensco, can help you with those, because our goal is to keep you out of trouble and help you grow your investments. So we don't want anybody getting into trouble. I would say, however, in my 22 years experience, I've only had 6 Roth IRAs ever investigated by the IRS, and none of them were ended up in distributions and taxes and penalties. So.
Knock on wood.
Yes. But it is rather rare. But our approach is 100% protection. I mean, we don't want anybody to risk their retirement account, and so we're pretty strict about, if we see somebody engaging in a potential prohibited transaction, we will challenge it and ask them for an explanation or ask them for a legal opinion from a professional attorney to give us reason why we're wrong. If we were satisfied with that reason, we'll go ahead with it. If we're not, we just won't do the transaction. I mean, I was recently, a couple of years ago, I was approached by a famous TV actress who asked me, and her certified financial planner asked me to do a transaction that was clearly a prohibited transaction. And she had $1.5 million IRA at our firm, and I said, I'm sorry, unless you change the parameters here, you can't, this is not going to work.
Yeah.
And they get very upset, the two of them, and I said, well, you know, you're not going to do it at Pensco. And so they put in a transfer request to go to another competitor, and I picked up the phone and told the competitor what was going on, and they rejected it as well. So our industry, the REITA Association, has a zero tolerance for prohibited transactions, because we think it's not only good business for us, but it's good protection for the client.
Well, of course. Unfortunately, I had to deal with one this year, and it was a very unhappy situation. So the consequence for a prohibited transaction, folks, is that the account is considered to be disqualified and distributed at the beginning of the year. It's really serious.
Beginning of the year when the transaction occurred.
When the transaction occurred.
If that was 4 years ago, because they're just getting around to auditing, then you have compound taxes and penalties.
Yeah, and that very nasty. Tom, we're just about out of time. First of all, folks, I want to let you know I wrote a little book about this stuff, how to use a Roth and IRA accounts to provide a secure retirement. You can get it at Amazon or Barnes & Noble or online. And it's also on Kindle and Nook and all that stuff.
Wow, you're really getting the state of the art here.
Yeah, and Tom actually looked it over and gave me some really good comments, so I appreciate that. And Tom, again, I think we're about out of time, so I'm going to thank you for joining me.
My pleasure. I'd like to come back again sometime. And
you bet. And we will be doing another interview, folks, so keep an eye out. And also, these will be posted at financialinsiderweekly.com under past episodes. We'll see you next time on Financial Insider Weekly.